In problem 3, as we review for the first exam, it's taking an income statement and a balance sheet and saying we forgot to make some entries and asking how it impacts it. And just so you remember that net income is revenue minus expense, and that assets equal liabilities plus shareholders' equity. So in requirement 1, it says if we forgot to accrue our salaries for the last 2 days of the year of $2,000, that means that if we did make that correcting entry, that net income would go down by $2,000 because it would be debit salaries expense and credit salaries payable. So salaries payable, a liability account, would increase $2,000. Now, because net income was reduced, that means shareholders' equity would also be reduced because net income gets closed into retained earnings at year end. So that's how it would impact the income statement and the balance sheet. Number 2 says depreciation of $30,000 had not been recorded during the year. We know that that entry is debit depreciation expense, which would make the net income go down $30,000, and credit accumulated depreciation, which would also make our assets go down $30,000. Because net income was reduced by $30,000, shareholders' equity would also be reduced by $30,000. Number 3, interest on a $20,000 10% note receivable dated July 1 was not recorded. The interest due to be paid on maturity date of the note. In other words, we're going to accrue it, but we'll pay it later. Now, the first thing we have to do is figure out how much interest. So if it's a $20,000 note, 10%, and it was dated July 1, and it is now December 31, that's half a year. So that's $1,000. So this is a note receivable, not a note payable. So we're going to receive the interest, so revenue would increase by $1,000, and so would our interest receivable. It would increase by $1,000, and since revenue increases, net income increases, so shareholders' equity will also, retained earnings, will also increase by $1,000. Number 4. 4 months of rent had been collected previously of $4,000. At year end, 3 months had been earned. So this has been sitting there in unearned revenue, and it really belongs in revenue. And 3/4 of the $4,000, or $3,000, 3/4 of $4,000 is $3,000 have been earned, and if it's been earned, it belongs in a revenue account. So revenue will increase $3,000, which increases retained earnings $3,000, and our liabilities, since it was an unearned revenue, decreases $3,000. Number 5, supplies at the end of the year were $1,000. All supplies purchased during the period have been recorded in the supplies expense account. So they've been sitting in an expense, but where they really belong is in an asset account. So we need to take them out of the expense and put them into an asset. So I'm debiting the assets and I'm crediting an expense. And by crediting an expense, we're making our net income larger, which makes retained earnings larger. So right now we're going to take an adjusting balance. So notice that net income started at $100,000, and with all of these adjustments, net income is now at $73,000. And assets started at $300,000 but have been adjusted now to $272,000. And liabilities started at $150,000 and now have adjusted to $149,000. If I did all my math right. And shareholders' equity started at $150,000 and is now at $123,000. And notice that assets still equal liabilities plus shareholders' equity. Isn't that amazing? So income taxes. Income taxes are 15%. So what I needed to do is to take 15% of $73,000, my new revised net income, and I find that my income taxes are $10,950. So I debit into income tax expense, credit income taxes payable. So notice my liabilities increase, my net income decreases, which decreases my retained earnings by the same amount, $10,950. So the correct final balances are that net income is $62,050, that assets come to $272,000, liabilities grow to $159,950, and stockholders' equity is $112,050. Now, the problem doesn't stop there. It asks us to compute earnings per share. And earnings per share is net income divided by the number of shares outstanding. So we've now found that net income is $62,050, and it says assume that 5,000 shares have been outstanding all year. So 62,000 divided by 5,000 shares is $12.41 per share. So that's our earnings per share, $12.41.